Good morning, everyone. So my name is Shan Pasupati, one of the lecturer for this workshop. Today we are going to talk about the week one. Welcome everyone for this workshop, as well as welcome to PTP. We will move into that workshop plan. So how we going to work out this whole workshops. What we're going to learn from this workshop, we're going to understand what the assessable income and deductions and offsets and some of the business activity statement concepts, such as goods and services tax, PAYG, friendship benefit tax, and etc. So end of the day, what you're going to learn, the rules required to prepare income tax return for individuals and businesses, as well as how to prepare the business activity statement. Then how we exactly we going to learn? We are going to learn through the Xero Practice Manager, or one of the tax preparation software. So you will be given to the access already. If you have some difficulty, please contact your tutor. They will assist you to access the Xero Practice Manager. So we're going to work on that Xero Practice Manager for all these 16 weeks of the course. The course commitment, the course duration or the workshop duration is around 16 weeks. The 12 weeks going to be a video conferencing. So you all guys will be in the environment with this Zoom every week, 2 hours. There will be a external studies required. So we will give you some homework questions and practices you to practice through the Xero Practice Manager. So not only just these 2 hours, you may require to some additional other 3 to 4 hours of work using the Xero Practice Manager. Then the course material available online. You will be emailed to that link and password. There will be a new password soon, and I will share the screen with you guys. The where is that you can see this is in our course portal. You can see readings available, assessable income, deductions, and business activity statement. Every heading at this point, assessable income we uploaded. Every week we will upload that to your PowerPoint and homework, normally a couple of days before your workshop. And the recording will be available most probably Monday or Tuesday morning. So you can access that all the video conferencing what we did in the weekends. So that's the course portal. This now we email to everyone this course portal link. Anyhow, that's there will be a password change. Therefore, you will receive the password soon. And homework. So I will going to share that screen back to in our PowerPoint. Here it is. The homework. So you require to do that number of calculation using that Xero Practice Manager in our software, and you no need to submit to any work to tutor or us, but you must make sure that you are getting the right answers. So the homework will come with the answers. So your responsibility to go and do it through the Xero Practice Manager. If you not understand anything, you could ask from the tutors. Right, so the homework solutions available in that same attachment. Tutors, number of tutors working on this project. So you can email to the tutor@taxbook.com.au. They will back to you in a very reasonable time frame. They are not available through the phone, unfortunately. However, when you send that email, if they think that is required, they will arrange a Zoom meeting with you and resolve your Xero Practice Manager issue or some clarification on in your tax related or your workshop related questions. Final assignment. So in the final assignment, you are going to prepare the tax return and a business activity statement we call BAS, which will be available on 30th of May 2021. You could access, and 1 week time you will be given to complete all of your whole final assignments. When you complete it, you can submit through the Xero Practice Manager. So that's the assignment, that the recruitment related inquiries. So this workshop purely for that academic or that tax and best preparation skills. If you have any recruitment related inquiries, you must email to admin@taxbook.com.au or to Ben or other managers who is working in the human resource area. Then that last, the lecturers for this course, myself, Shan Pasupati, my details can be accessed through that. There's a little link over there, as well as Peter Lonex, one of the senior tax agent and accountant and lecturers. So we sharing this workshop between us. So if you would like to read our profile, so you can click on that and see what's the skills or what are the experience we have to work with you in these workshops. I'm working last 20 years in the accounting area, and last 12 years I'm working full-time academic with university and type system. So that's a workshop plan. Now we will move into overview of the tax system. Australian tax system is a progressive tax system. What's the meaning the progressive tax system? When your income rates increases with the increases of taxpayers' taxable income. For an example, in your income, if you are a resident, if your income around $15,000, you are not going to pay any tax. But if your income goes to 25,000, you may be going to pay around 19 cents, anything above 18,200. If your income, for example, 250,000, you may be pay around 45 percentage, anything about 210,000. So like that is a tax rate increase 0, 19, 32.5, 37, and 45 percentage. I will show the table within a couple of slides later. So individual tax returns is a progressive tax system. It's means somebody who earn more income, they're going to pay more percentage of the tax, right? Not the more tax. Yes, when the income goes up, tax will goes up. That's we all knows that. But the more higher income tax rate. That's a very important. That's a progressive tax system. However, this progressive tax system only applicable to individual like you and me working for others or earning some business income from the partnership or sole trader or trust as a beneficiary. But if you are going with that company tax system is fixed, a specific percentage. For an example, at this stage, 30 percentage for most of the companies. It's the companies who met some criteria to come as a base entity, they will get it 27.5 percentage 1920. This year 2021 will be 26.5 percentage. So what I'm trying to say, it is a fixed rate for the company, and individual tax system is going to be a progressive tax system. Pay as you go. You may heard about this word. All of your payment pay slips, you can say a little component, pay as you go. They're taking out your salary and send it to ATO, right? So in our Income Tax Assessment Act 1936 or 1997, what is asking, we must assess our tax liability end of that every tax year, which is normally 30th of June that particular year. So when we assessing end of the year tax liability, if you say this much of 30,000 or 20,000 of the tax, very hard to pay by taxpayer. Therefore, ATO come with the administrative arrangement through a new Tax System Act in 2020, paying your tax in advance. Right? What's that? Paying your tax in advance. So they come back with that idea and ask to that from that taxpayers to pay their taxes in advance. So what is the meaning? So while you are earning, you are paying the tax in advance. End of the financial year, when you submit your tax lodgement, we will settle that matter. Right? So settle that liability. So how is that work? So if you are working as an employee while earning your salary, that employer must take a little bit from using some formula, calculate the tax advance and send it to ATO. That's called PAYG withholding. What's the meaning? PAYG withholding mean employee paying their taxes in advance through the while they are earning their salaries and wages and commission and overtime and then etc. The business is going to pay through their PAYG installments. So businesses normally doing their business activity statement every month or every 3 months. While they are doing the business activity statement, they're going to include their income tax in advance. That's called PAYG installment. So there are two type of tax paying advance system. One called PAYG withholding, other one called PAYG installment, right? PAYG withholding for employees, PAYG installment for businesses, right? How we have employees paying the PAYG withholding? Through their salaries and wages. How that businesses paying their taxes in advance? Through their business activity statement. So, so that's called PAYG. Next, income tax assessments. End of the income year, that normally, as I said, is 30th of June of that particular year. Most of the people, they must lodge their tax returns to ATO. All right. So there will be a prescripted form. You cannot change the form every year. ATO going to say this is the form you must report. So that the same form will be available in your Xero Practice Manager or any other tax preparation software. They cannot change it because the form is provided by Australian Tax Office. So that the same form will be available in your Xero Practice Manager or whatever software you're using to lodge that in your tax return, and provide that all the your income and expenses and other personal details. Tax Office will be assessed and say how much in your total liability for the whole year. So when they assessed 1st of July to 30th of June, this much of tax liability, then what's going to happen? They will check that how much you paid through the PAYG withholding system or PAYG installment system and balance it out and say this much of refund. So normally you will get a notice of assessment end of the year to show that all of your income tax summary, right? So like a settlement statement from ATO saying that this much your income, this much your Medicare levy, this much your tax offset, this much you already paid. So here it's the balance. If you paid more through your PAYG withholding system, you will get the refund. So most of us, we will get the refund because the system is calculated based on your actual assessable income. So I will talk with you in the next slide. Sometime you may be paid less. Tax office is going to ask you to pay within certain period of time, right? So that's your notice of assessment. This notice of assessment only will be issued to the individuals like you and me. The notice of assessment not issued to that companies, right? It's only issued to individuals. It's not issued to any businesses, right? That's in our overview of the tax system. Then we will move into that determining tax liability, right? How tax liability is determined. Mhm. So first one, the assessable income. So in our accounting, we have that sales and operational expenses, cost of goods sold, net profit, think different terminology we're using in our accounting system. However, we not use that accounting standards or accounting terminology in our tax calculations. We have other technical terms, which is assessable income and deductions. And if you take it out as deduct that deductions from the assessable income, that's called taxable income. You can say something like that in your revenue minus your total expenses equal to net profit. That's the one you say in your accounting system. Here we use the different terminology, different definition for assessable income and deductions and taxable income than your accounting standard. It's not going to be all the revenue, not going to be assessable income. All of your expenses, not necessary for allowable deductions. Right. For an example, if you pay some fine, you may be include as a expense, but we cannot include as a deduction. So we will talk that one a little bit detailed down the track. So the tax calculated based on taxable income. So how are we going to get the taxable income? assessable income minus deductions, right? So 65,000, we put the example 65,000 and allowable deduction 5,000. So taxable income going to be 60,000. So now we want to calculate the tax for this 60,000. We will use tax rate. So I'm using that individual resident tax rate for this example, which is 11,047. All right. So we will practice this one in a couple of minutes time through the Practice Manager, how I got it this number, right? Then you may have eligible to some tax offset. What is this tax offset? That's depend on the government policy. The tax office giving some offset from the tax. It's mean reduce the tax liability based on the individual income and other circumstances. There are a number of different tax offsets available for taxpayers. It's including lower income tax offset, lower middle income tax offset, and so on rebate, and foreign tax credit tax offset, number of different tax offset. We're going to work on this workshop. So I just calculated little lower income and lower middle income offset here, which is 1,180. So we are going to reduce the tax liability. Now assess tax payable 9,867. So this much of tax, because tax office or that government policy allow the taxpayer to reduce their liability based on their circumstances. We will talk what is that eligibility criteria for offset and etc. and down the track. Now we got that as a tax payable. How much is this? 9,867. Then we want to calculate Medicare levy. So anybody getting that Medicare benefits, or if they satisfy that Social Security Act 1991, they may be required to pay Medicare levy. So how much the Medicare levy, it's depend on that number of factors in your taxable income, in your family circumstances, and etc. etc. We will talk very clear down the track. So at this point, you only to understand the Medicare levy is charged if someone eligible to get the Medicare benefits, or or someone who satisfy the Social Security Act 1991 to get the Medicare benefits. Right. So that will be added with your 9,867. Now they come to 11,067. That's in our total tax payable. Then, as I said couple of minutes before, PAYG withholding, right? You maybe pay some tax in advance, so that whatever tax you paid in advance, that will be in the ATO system. Normally, as a tax consultant, you can download through that Xero Practice Manager, and you can assume that this client already paid 15,327 for an example, right? So 11,000 he should pay based on that all the calculation, but he already paid 15,327. So difference between two, he will get the refund. So he could get a fair amount of $4,260 refund, right? So this is the way normally we do that um, in our determining the tax liability. So what exactly you're going to learn from this course? Skills and knowledge required to prepare the tax return. You understand assessable income, deductions, offsets, and Medicare levy. So there are four components of important uh, technical term. If you understand that four components, rest of the stuff the software will do. Right. So every year there are a number of changes in that tax legislation. All the changes will be accommodated inside the software to calculate the formulas and functions. But our responsibility to key in the data accurately based on the tax rules. So what we're going to work, we're going to understand what should be included in the assessable income, what should be included in the deductions, what are the information we should provide to get the tax offset correctly, and how we going to calculate the Medicare levy correctly. Right. So when you put it that all the information right, you will be a good tax consultant. So that's the one we're going to work next 12 weeks time. Right. So now what I'm going to do, I'm going to share with you guys that in our um, uh, in our Xero Practice Manager to see that how you understand. Right. So give me a 2 second. So now what the screen you guys seeing, that's called Xero Practice Manager, right? So this is the software you're going to work later with this course. So somebody, you have some difficulty to accessing the Xero Practice Manager, I understand. If you have difficulty to access, please contact your tutor at textbook.com.au. They will resolve that problem as soon as possible. It's very user-friendly software because of some Google setting, or that some settings, it will be make some difficulty for you to access. Then normally couple of way we resolve the problem. So you go to the new browser and access, it will work. It's mean, for an example, I'm going to that using the Microsoft Edge, right, or that one of that other software browser, it may be work. Or go to clear your history, right, the full history you clear, it will be work immediately. So most of you guys are trying through the um, Xero, the actual Xero software, the Xero software will come up with the blue screen, right? If you are trying through the blue screen, it will not work. This is the green one, right? The practice manager, which is different from in your normal Xero, right? So therefore, please that access through the Xero practice manager. You maybe get it something called something wrong. What's the meaning? You are really that not accessing the right software, right? So I'm going to put it this one quickly and show that how does that work. I will put that my, what is that, 47037103771. You can see you will get it some message like that. So what's that happen? I did not add it here to show you what's that issue. So you should go to the Xero Practice Manager. So every time when you log in, you want to search Xero Practice Manager login, not Zero login, right? Zero login is this one. It's a blue one, right? It's a different access. You can see I will show you. You know, this blue one is a zero, right? So you have no access to Zero at this point. When you start your bookkeeping work, you maybe have access. So at this point, you want to access through the Xero Practice Manager. There are three immediate issue you can sort it out. One, you can go to your Google and clear that your history, and then you work that click here, clear history, browsing data, and clear up all the data. That mean it will work because your previous Zero login will the issue. The second issue may be you are trying to log into that Xero, which is that I showed that the blue screen, which is not going to work. So you must go to that Xero Practice Manager and access that one, right? So when you access, it will work. If it's not work, most of the reason why it's not work, you may be registered your email previously for a demo version or any other paid version with the Xero. In that case, your email account may be locked. Then what you can do, you can create a new email address and send it to that tutors. They will give you the access to the new email address and remove the previous access. In that case, you are freshly have that new access to this one. So this is the way we could resolve this problem. However, the first point of contact, the tutor at textbook.com.au to resolve the issue. If you resolve the issue, you can see like this green color screen. You can see different screens here. We will work all these different screen later. Today, I'm going to create clients, right? Already we sent an email to you with the instruction how to create the clients. I'm sure you guys are familiar with that one. Anyhow, I will just go through that. So, right, some reason asking this one again. Give me a 2 second. I will just log in that one. Yeah, it's going through. Normally it will go to that other page and then it'll ask. Again, we want to show any authentication codes required. What is the code now? It's every second it will be changed, not second or 7, 8, 2, 4. Good. So we got it here. Excellent. So we got it that now Xero Practice Manager active here. So I go to the client. So you can see so many clients, people working on. That's good. So we will go and create a new client. You create any amount of client. That's entirely up to you, right? You are free to work on that and create number of clients and work more and more. So we will start the new client and click on that individual. You can see there are different options depend on what kind of tax return you prepare. You want to create the client for company or individual or partnership, or we are not going to do at this page. You're not going to involve with the self-managed fund, but you will do that down the track. Sole trader, super fund, and trust. So that I will put it that come individual, right? So that's the one first we want to. All the time you want to put it your name. Your name will come up here, but I am going to put PTP tutor or something. Yep, tutor. So we will put the tutor here as well. Manager also tutor. You don't need to put it any other. Both should be same. And now I'm going to put Steve Simit, right? That is in our client. So as what is the date of 1/1/1972? So we have the date of birth and put that here, Mr. All right, and we will go to that mail, and you want to put that his phone number, right, and his for email address. Right. So, and very importantly, don't worry about that. This too at this point. It's an individual client. Address must be better. You get it through the quick find. Right. So 12 Young Street. I'm putting the right dates. You want to wait until that your address come up here. Right. So I couldn't guess. I'll change it. 112 Young Street. What's happened? Yep, it's got it Parkside. Oh, that's WA. That's good. So you can see automatically pre-fill. We don't want to type it. So why I'm doing suggesting this one? Most of the tax returns are rejected in that system, automated system, when it's if you type wrongly the address or if you put a little comma here or something like that, because that always match with that PLS, one of that in our tax office uh, online platform. If not matched, that tax return will be come back to us as a rejection. So therefore, most of the time you use that properly, your contact details, and that your tax file number of your client. I did not put it anything here. Right, you can type it, an ABN if it's required, ACN of anything. But this is the one very important. If you not click this one in the Premier Tax and Bookkeeping, you won't tick this all too and put that information after today's date, right? I'm going to put that after today's date. First one for activity statement, BAS. Second one for tax form. If you not create that client, if you not create that, if you not tick these boxes, you cannot create that tax return. So this is one of the key information. You can see so many personal information we include. This platform what we are using, it's a training platform, so there are a number of people in this one. So therefore you should not use any of that your personal information in this platform, right? Email or address or phone number or your name or anything should not used, or date of birth or tax file number. For don't use it anything, just put it whatever you like, some imaginary names, right? When you include that names, you can practice. Whenever we give you the next level of access as a consultant, you can after that you can use all the correct data. But to get the training, it's not required to that correct data, so you can put it whatever you like and work it on. So that's very important. You should not use any of your personal information in these sites. Now you save. I created a client. You can see Steve Smith, client individual. Then I'm going to create one more client. So as a company, because we're going to work today, company and individual. So I want to go to the client again and click here and go to the company. So again, partner, PTB tutor, I will put the same person here. All right, it's good. And you complete this, we'll say AB's ABN Private Limited, right? Right, so that's going to be ABN PTB Limited. So go to the contact details. You put it all the details whenever you can, but come to here. Very important. Otherwise, you cannot work on that, right? But while you are doing practicing, other than TFN, you put it all the information, some imaginary informations, right? The date should be go after today's, whatever date I will do, I will put it here, all right? So good. This is not necessary to provide any bank account number at this point. Say, so you have new two companies. One is that company, other one is the, put it next to each other. It's easy for us. And I think I no need to this one now. Yep. You have the individual client and you have the company clients. Excellent. Now, what is we saw that in our PowerPoint little couple of minutes before. So we determine the tax liability for a individual, right? So we will see if that information for individual, how is that work? So if you want to create a tax return, you want to go to that tax and create the return, right? So when you go to the return, you can see job. Don't worry at this point. Click the Steve Smith and ITR, income tax return. Then which year are we going to do? We're going to do 2020. We just give you five different 2014 to now, but you click the 2020 tax return, right? We can go back and do the tax returns as well. So when you click this one, you can see we are going to get it a tax return. How nice this one. So nice warning because we did not put this information. That's fine. We will work it out later. I'll click this one and take it out. So now you can see empty tax returns. So normally when you work, what normally do, go to here, click on the online PLS pre-fill. So what's going to happen? All of the tax office record will be pre-filled here. Their salaries, their bank interest, their dividends, their insurance, their allowances, their job keeper, everything will be pre-filled here. You no need to um, uh, retype anything, but I am going to show you manually today because you're going to do, you have no access to that pre-fill. Pre-fill not going to work here because we disabled that access to you guys at this point as a you guys are still that working on to reach your consultant contract. So now you can see there are a number of icon or that's button in the side. So this everything should be provide the information. This is a summary will give us, tax calculation. This is a summary, but this is the full estimate of your tax. And this all the income you are going to include. This is all the deductions you are going to include. All the offset you're going to include here. Your Medicare levy information here. Your income test, right? We will explain to you down the track what is this one. And your spouse, if your client have a spouse, you're going to put her details here, or otherwise you can create and link the wife. So for an example, I assume that Steve Smith's wife name, right? I just showing to you how to link, right? So what we will do, we will create a new client for C. Smith's wife, which is going to be individual. So again, I don't want the partner. I will later, Kathy Smith, right? So that's a name, right? So I'll say her date of birth, 1/1/1972. So no matter you are Mrs. Right and male. So only thing I want to go to here and put it this two and make it. So I created a client for Steve Smith's wife. So what I am going to do now, go to here. Either way, you can go to Smith or you can go to Kathy. I am doing through the Kathy. Click the Kathy and add relationship. I put that spouse. All right. So was the client name Steve. There are so many Steve Smiths, I think, that we worked at for. I will click, that's a little bit harder. So what we will do, other way we will drink, right? So we'll go to the Simit, then link Kathy. That's easy, right? Because so many Simits are here. So we'll go here, spouse. So normally you can search through the tax file number, so it's not going to be an issue. But I'm just Kathy. Yep, Kathy Simit, right? You can see it's come as a Kathy Simit. So now what happened? If you click here, go and submit spouse, you see Kathy's information will come up. When you do the tax returns for the Kathy, it's automatically her information will be fall into here to calculate the family Medicare levy, family Medicare levy surcharge, and other offsets and etc. So you no need to retype. So where most of the time husband and wife together come to the tax return. So what you can do, you create the two and link both of them, and it will be work. Same as when you come the partners and partnership, you're going to create a one partnership and link with the partners, and all the information fall into here, so you don't need to retype. So that's the beauty of this particular software what we are using. And I will take it out now. Submit only here. That's good. So we want to start that in our determine the tax liability. So what I will do is that I will go to that income. You can see number 1 to 24 different type of incomes here, right? So we're going to work on that in this workshop to understand where you are going to include all these different type of 24 incomes, right? So at this point, I'm going to start with that employment income. That's the one 65,000 we talk about in our in our example. So I'll open this one, the new item. This is normally pre-filled, but you are doing manually to understand, right? Australian salaries and wages. You put that payer's ABN number and their name and etc. But I'm interested only 65,000. Is he tax he paid 15,327. That's the two information from in our one. So you can see now taxable income this much of tax. However, in our example, there's a $5,000 deductions. So you can go to the deduction, you can say D1 to D15. There are different deductions. You're going to work out that what kind of deduction you're going to include in this one by one. For example, one D1 work-related car expenses. That will be common. As I said initially, this is come from ATO, not from the software providers. Which software you use, D1 will be work-related car expense. Any software you use, D3 will be this one, right? I'm going to put an example, where you know, that $5,000, I assume that that's a other work-related item, right? So I include that. So now if you go back to that in your PowerPoint slides, you can see in our taxable income 60,000, right? And so how much the tax, you want to go to estimate section and see here how much in our tax. How much the tax? 60,000 in our taxable income, 11,047. That's the one in our PowerPoint as a tax. Then we want to look into that, how much in our offsets, right? Click here. You can see the total offset, low income offset this much, low middle income offset this much. The total offset will be 1,180, right? Then you can see in your 9,867 in your PowerPoint slide. Then if you see the Medicare levy, 1,200. You can click here and see what kind of Medicare levy, only Medicare levy. There's no Medicare levy surcharge. It's good, right? So the 1,200. So now we can see 1,200. You can see in the bottom of the screen, $4,260 as a refund. So this is the way you're going to work out. So what exactly you're going to learn through that in our workshops, every single item here, how I am going to treat, what is the tax rule behind, where I am going to include in the income or deductions or offset or Medicare or spouse details and business. Business I will talk later, right? Now I go back to the company. We will start and assume that that income what we saw coming from company. So we'll click the return, right? And click that ABN Limited CTR, right? Company tax return. and you say the 2020, then click the save button, right? And then we will see company tax return. So I include here, good. So you can see CTS summary, same, different from individual screen, but almost most of the information you will be click and see how's that work. Down the track we are going to start. So income start from 6. That's the way that form designed. So I am going to include for goods and services they will 65,000. They have some deductions. I say for an example 5,000 goods of corn, right? So how much that income? 60,000. So what's going to say here? 18,000 you want to pay, 30 percentage, right? So now I come back and I want to say, hey, you already paid this much. So how much they paid? 15,000. So you want to come over here and put it wherever credits, tax payable. Uh, 1 second, give me 2 sec. Right, I will say the PAYG installment raised for 15 because this is a business, right? Okay, so now you can see that minus that 2,673, which is different from PowerPoint slide, because the PowerPoint slide include offsets and Medicare levy, and that's a different tax rate. The company and individual have different tax rate. That's the reason you can see here 2,673, right? So this is the basic understanding of your Xero Practice Manager. You're going to work with that one by one, how it's going to be, you include all the information in this course, right? So what we will do, I will just move into that other area in a minute. So I'm going to give me a 1 minute break, then we will start. All right, we're back to here. That's again in our original slide, which is we talk about that determine the tax liability. This is the one we talk with that other CTR. So we will see in that next slide. Next slide. All right. So we'll move into the what is the next slide. So what we're going to learn. So as when you see that tax XPM Zero Practice Manager, you say number of lines in the income and deductions and other tax offset informations. To put it the right way to you pass the data entry, you require to understand what the rules behind. So in the workshop, you're going to learn in our income tax legislation, that's the base legislation for any tax preparation, which is Income Tax Assessment Act 1936 and 1997. Then you're going to understand some case law. What's the meaning case law mean? If any federal court decisions about that income tax related matters in the courts, that decisions will come as a binding rules for the tax law. So it's mean we can refer that particular case, this is the decision, therefore we want to apply like this. Last one, your Australian tax office rules or guidelines, which is most of them are the based on the legislation, but as a normal taxpayer, very hard to read and understand the legislation. Therefore, it your provide very user-friendly version of the legislation through the website and other publication, or especially the taxpayer easily understand how to work with the ATO. So whatever rules you see in that or guidelines you see in that ATO website, which is available to that taxpayer to easy to understand the rules. So we're going to use the combination of all of them in this course, and we will see how you understand to apply that particular rules into that actual practical world. Then we will the key concept, right? So I will start with that taxable income, which is equal to assessable income minus deductions, right? So as I previously indicated, so tax calculated based on the taxable income. You may earn $100,000 in your salary, but you are not going to pay all the 100,000 if you have some deduction, because 100,000 minus your deduction may 80,000 or 60,000 or 50,000, whatever number come up, that's only you going to calculate. So that assessable income have two part, one ordinary income, other one statutory income. So at this stage, I am introduced ordinary income mean you regularly get any income. For an example, salary, wages, commission, this type of stuff in your day-to-day normal, regular, and periodic incomes. Right? Statutory income mean in our tax legislation going to introduce or legislation saying to us you must report this income regardless of what. Right? For an example, capital gain, right? That type of some infrequent income, right? So that's called statutory income. The deductions have two part, general deduction and specific deductions. General deductions mean any expenses normally connected with your assessable income, that's we can say general deduction. For an example, you are running a business, you are paying wages and commissions and electricity and gas and advertisement and marketing. All these expenses are normally a general deductions. However, sometime that rules will come up from ATO or from the legislation, you can deduct or you can't deduct these expenses. That type of things called specific deductions. The good example is that immediate write-off rules, right? So after the COVID, the government announced if the businesses if meet the criteria or eligibility criteria, they may deduct any capital assets if they purchase more than less than 150,000 immediately. That's called immediate write-off. That type of specific direction from the legislation or ATO, that's called specific deduction. So we going to work on the ordinary income, statutory income, general deductions, and specific deductions in this course. Now, income year, the normal tax year for us, but we are working with this practice now, 1st of July to 30th of June. That's the one tax office ask, right? The 12 months from 1st of July of that year. So, for example, if you're preparing the tax return for the 1920, you must select 20 in the Xero Practice Manager 2020. What's the meaning? 1st of July 2019 to 30th of June 2021. My apology, there's a wrong year in that PowerPoint. So whenever you select that your Zero Practice Manager tax year, your year will be the last day of that particular financial year or tax year. So if you prepare the 1st of July 2017 to 30th of June 2018, you're going to select 2018. If you select 2020, your period will be 1st of July 2019 to 30th June 2020. The next year, this year, when you're preparing the tax return, you're going to click 2021. What's the meaning? 1st of July 2022, 30th of June 2021. Right? So that's very important. Sometimes we prepare the tax return for previous years, right? So the end part of that your financial year will come up in the Zero Practice Manager. Income tax liability. All right. So now we will little bit start with our income tax and see how the things goes. The main tax you pay is the income tax in Australia. We have number of different taxes: friendship benefit tax, goods and services tax, payroll tax, right? Luxury car tax, fuel tax credits. There are a number of different taxes. We are going to familiar with this workshop, but the main tax is the income tax liability, right? Goods and services tax, a main one. So, what is that income tax liability? When you sit in front of the client, you want to get it first, some basic income everybody earn, right? First, we will start with that employment income. What's that employment income? So, because of employee-employer relationship, if you receive any income, normally we call that one as a employment income. However, in our payroll and in our accounting setup, we're using number of different terminologies to get that. So for example, salary, wages, commission, bonus, right? Overtime, travel allowance, meal allowance, car allowance, laundry allowance, uniform allowance, study allowance. So many different terminology we use. But end of the day, for the tax purpose, everything's one word: employment income. right? So you no need to worry about the different terminology, what is in that payslip and or that payment summary, or that what client saying to you. Your question is why you receive this income in your bank account because of your employment employee relationship. So 99.9 percentage chance that should be a assessable income. Taxpayer must pay the tax on that. There are some very few exemptions. I will talk next week. For an example, reimbursement of expenses. That's not going to be a income. Or fringe benefit tax. That's not going to be a income. Superannuation paid. That's not going to be income, right? So these three items you can exclude. What is that? Superannuation, fringe benefit, reimbursement of expenses, right? But any other income you receive from employer, normally we must include as an income, right? That's the employment income. Second one, investment income. We are investing that money in the different um, investment portfolios, right? That may be a property, that may be assets, that may be investment shares, and etc. etc. Normally, you received income from your investment. That may be a rent from the investment property, from your bank account, little interest, or from your share, some dividends, or some royalties. So this all will be included as a investment income. So when you work with the client, step number one, you want to see what is that employment income. Second, you want to check that investment income. These are the common income. You want to work on that, right? Next one, the business income. The business income mean buying and selling or providing the services, business earning the income. So what is the amount you going to include as a assessable income in your total sales excluding GST? Your total sales excluding GST. Sometimes we think we won't include only net profit. No. So in your business income is accessible in the full amount of money you receive from your customers or you may require to receive from customers, right? So that's but excluding GST. For an example, if your client's total sales 110,000 including GST, you're going to include 100,000, right? You don't worry about the net profit. Don't worry about the expenses at this stage. We will use that for deductions later, right? At this point, as a income, total income should be reported as a assessable income, excluding GST. For example, your client, a cleaner, so his total income $60,000. He not registered for the GST. In that case, yes, you are right. He is not registered for the GST. Therefore, we're going to include only $60,000. The previous case, 110,000 including GST, you take it out the 10,000 GST out, only going to include 100,000 because GST you collected from your customers not belong to your business. That belongs to ATO. So we should pay back to ATO. Therefore, we no need to include. Then you want to check with the client about the government benefits. There are a number of different benefits available for the clients, which is include in your which is include study payment, new start allowance, youth allowance, right? So like most of these allowances are taxable. So the clients normally think that when they receive the payment from the Centrelink, they believe this is not taxable, right? Not right. That's going to be taxable. However, some payments are not taxable. I will talk with you in our next week workshop. So at this point, the age pension, carers payments, or study, new start, and youth allowance, normally it's government benefits. It's taxable. You must include in your XPM. I think number 5. When you go to number 5, you can see Australian government allowances and payments like new start, youth, and or study payments. You're going to enter that information in the number 5. So then we will say tax levied, right? No matter you are individual or businesses, whatever income you receive, you're required to pay taxes, right? I will start with the individuals. Individuals, no matter resident or non-resident, he required to pay the tax, right? For an example, a person come from abroad, performing some um, um, arts or sports here, they're required to pay the tax. For a dancer come from abroad, a singer come from abroad, a cricket player come from abroad and earn some income from Australia, or Australian opener, open tennis, someone come from abroad and earn some income here as a winning prize, they want to pay the tax. So resident or foreign resident or non-resident, they're required to pay the tax. When you run the business is also required to pay the tax, but there are different tax treatment for the business we will talk about in a minute. There are four different type of main business structures. One, sole trader, which is individual, right? So sole trader tax with the individuals always, right? Or partnership or trust or company. The partnership, what's the partnership? Two or more people join together running a business to sharing their profit or loss, right? So therefore the profit and loss shared between partners. The partnership not going to pay the tax, but partners going to pay the tax. How much they're going to pay the tax? End of the year, partnership should prepare the tax return and lodge the ATO and say how much in our profit or loss, assume that profit and shared between the partners. So that information will be provided through the partnership tax return to ATO. Then individual partners, when they prepare the individual tax return, they must include that partnership income. Then that will be goes to ATO and they will match with that both partnership tax return and individual tax return. So partnership not going to pay the tax, but they will be benefited from, they will be shared, whatever amount they shared, that will be paid by partners, right? So I will talk with the partnership in very detail in later. Next one is the trust. So trust is the vehicle to minimize the uh, income tax. That's the main purpose. There are a number of different trust setup available: family trust, discriminated trust, trading trust, right? Unit trust. So all these different trust setup to minimize that individual tax liabilities, right? The trust, there are three different way we handle it. So I may explain to you through that an example in a minute, right? So I'm going to share the screen with you guys with the Xero Practice Manager. Why they setting up the trust? That's the one you should understand today. Later, I will explain everything clearly, right? So I will take it out this the previous example of this deductions and expenses, right? So now it says zero. Assume that a taxpayer got that 100,000 income from his property. So how much the income is getting? 100,000. So I'm going to type that this income as 100,000 net income, right? Where's that? This go to here business. Yep, I typing 100,000, right? How much the net income is getting? $100,000. So how much that tax he required to pay as per this calculation? 25,717, right? Very expensive. I think I want to check that quickly. That I think because of his wife, that's fine. Yep, 25,717. It will be a change. You know, I include that spouse for Steve that she have no income. That may be one of the reason it's showing. Otherwise, different number. So 25,000 he should pay. So very expensive. What Steve can do, he can set up a trust and hand over the property to the trustee or business to trustee to manage the property. Now he want to write a terms and condition when we hand it over to the trustee. That's called trust deed. So in the trust deed, he should identify who are the beneficiaries. Assume that the Smith family fully depend on this $100,000 income. He have wife and three children. They are studying at uni, but they don't have any other work. The full-time students, right? All three kids over 18, right? For some easy to understand. So end of the year, what the trustee will do, they will share that this income between all the beneficiaries. Simit said in my home, 5 beneficiaries. So easy to set up. So what Simit trustee will do, they will share that particular income between the beneficiaries based on the what is the best tax minimization strategy. At this stage, all five people not working, therefore trustee what will do, they go and say everybody will get 20,000 because you don't have much work. How much now Simit going to pay? $0. Every individual at home, how much the tax they are going to pay? $0. Therefore, the total tax, how much the Simit family going to pay for the 100,000 now? Zero. This is the reason, main reason people setting up trust, right? So the initially that Steve required to pay 25,000, right, for that his whole income. But he did that, he used that his family and used that trust and trustee and distributed between them. Then it is comes as a $0 for Simit, and every individual in the home the same 20,000 $0. So 0 times 50 for all 100,000, they did not pay that $25,000 tax. So this is the main reason the trust business setup available in the industry. So we will talk about the trust tax returns very detailed in our week 10, I think, lecture 10. So at this stage, you should understand there are a different business setup. So trust not going to pay the tax because trustee going to divide all the income to the beneficiaries. Therefore, when it is taxable income is zero for the trust all the time because everything will be distributed between trust beneficiaries. So when we lodge the tax return for the trust, same as partnership, no tax most of the time. But beneficiaries, when they lodge their tax return, it will be matched with the trust, right? So that's the way it's work. Last one is the company. Company is a separate legal entity. Give me a 2 second. I will go back and share it in our PowerPoint. Company is a separate legal entity. So therefore, it will be treated as a same as us, artificial person created by Corporation Act, right? So therefore, tax also, he should pay the tax. The company should pay the tax, the different percentage, 30 percentage or 27.5 in 1920. So we want to work it out who is going to pay different tax rates, right? So at this point, individuals and companies required to pay the tax. Sole trader and partnership trust not going to pay the tax, but that income will be linked with that individuals or partners or beneficiaries. They will pay the tax for that, right? So that's a tax liability. There are different tax rates, as I mentioned, residents and non-residents getting the different tax rates. Um, we want to work it out. Companies have two different tax rates, for one for the base entity, other one for the other companies. So we will see in the next couple of slides what the different tax rates involved with the resident and non-residents and companies. Okay, here it is, tax rates. You can have a look quickly. You can see there are um, 5 different layers, 0 to 18,200 taxable income, no tax. This is the resident tax rate 1920. 2020 is the different. We are not going to use any 2021 tax rate because whatever you are working in that XPM only available this 1920 tax year, 2021 only available after June, end of June. So therefore, we will work on the 1920. Whenever new tax table come up, everything will be updated in the system. So you no need to worry about that. So at this point, first bracket, nil, so 18,000 to 37,000. You can see 19 cents. It's going up 32.5, 37 cents, and 45 cents. This table will be um, uh, um, linked with that in our Xero Practice Manager with that online system. So we no need to remember all these nuts and bolts, but simple is that you should understand that resident tax rate is different from non-resident tax rates. You can see non-residents, they paying every single dollar earned from Australia. For an example, somebody won that Australian Open and they got that $50,000 or $150,000 winning prize. they should pay that 32.5 percentage every single dollar. But if the Australian want that, they no need to pay. You can see first 18,200, they no need to pay. Second, there are different calculations. So there's you can see the resident and non-resident tax rate is different, right? Then we move in the company. The company tax rate normally 30% for all the companies. If somebody satisfied that somebody satisfy the base entity criteria, you will be pay only 27.5% in 1920 and um, uh, uh, this year really 26.5 percentage, but we will go with the 1920 rate, right? The base entity mean who is base entity? In 1920, turnover less than 50 million and not door, right? And your income 80% or less, the assessable income is passive income. What's the meaning? So you should not have over 80% passive income to get it base entity. So a little bit confuse you. What is this passive income? Passive income, I put the link here. So you can go and that read it. When you click, it will go to your website. Interest and dividends and royalties, normally called passive income. So most of the insurance companies and banks and financial services institutions may be not eligible to base entity because their income mainly come from interest or um, um, other passive income. So you want to check with that. But normal businesses, what we're handling, mainly if they are less than 50 million turnover, they're normally not getting interest or dividend that much, right? 80% or more. So they may be eligible for base entity, right? That's 27.5 percentage. All other companies will be 30 percentage, right? So that's the way that's the tax rate works. So you can see different tax rates. So therefore, we must understand who is resident, who is not resident for the tax purpose, right? Who is resident, who is not resident for the tax purpose. We have three type of taxpayers in Australia. One called individual taxpayers, right? So one called individual taxpayers. The individual taxpayers have three part, right? So give me a 2 second, guys, and you're going to read this one while I am doing some adjustment on the other side. Right, so yes, you got it. So we have three type of individual taxpayers. One Australian resident is a taxpayer. If you are Australian resident for the tax purpose, your income will be assessed wherever you earn in the world, right? So whatever income you earn in Australia or outside of Australia, all the income will be assessed in Australia. You may be paid the tax in another country, there's no matter, right? Everything should be reported to ATO. What if you are an Australian resident for the tax purpose? If you are non-resident for the tax purpose, you are only going to report whatever income you received from Australia. You are not going to report any other income received outside of Australia, not required, right? If you are non-resident, there will be other one category, temporary residence. The temporary visa, so that if you are a resident here, you can be treated as Australian resident tax purpose. However, if you are not eligible to Social Security Act 1991, you may call as a temporary resident for the tax purpose. So not immigration purpose. That's different story, right? So how does that work? If you, in a practical sense, if I say, if you are not eligible to any Centrelink benefits, right? Social Security Act 1991, you will be called as a temporary residence. This means that you must report all the income from Australia and your income earned from employment or service performed outside of Australia, right? There are 5 different type of foreign income. We will talk next week, but only one type is employment income you must report here. Other 4 type of income, such as in your capital gain or you are selling a property in your home country, no need to report here, right? So we will see that one. So at this point, you focus on resident and non-resident. All right, the temporary resident mean they are Australian resident. They should report all the Australian income plus any employment income they receive from outside of Australia. Right. So this is the, so you can see the resident or non-resident is a very important because two different tax rate and two different tax treatment, because Australian residents should include all the income all over the world, whatever he earned, right? But non-resident, only they want to pay, but different tax, higher tax rate. So we will see what's the difference between resident and non-resident in the couple of slides down the track. So companies, so resident company or non-resident company tax rate is same, right? So no need to worry about the tax rate for the company. But if you are a resident company, you must report all the income earned from Australia and outside of Australia, right? But if you are a non-resident company, only you want to report what's the income you received in Australia. So you must know which one is the resident company, which one is a non-resident company, not for the tax rate purpose, for the purpose of include the income, right? If you're a resident company, you're going to include here income from Australia and anything they earn outside of Australia as well. But if it's a non-resident company, you focus on only whatever income they received in Australia. So company is the resident company. When it's a resident company, if the company registered in Australia under Corporation Act is incorporated here, that will be a resident company. Simple. Second, or it is incorporated outside of Australia, right? But carry the business here, like Uber, like Alibaba. So they all registered outside of Australia, but they're running the business in Australia. In that case, you want to check other two criteria. Where is their central management and control? If their central management and control in Australia, you can say you are a resident company, you want to pay here and outside of Australia income as well. Or you can see I use the word has either this or that, right? So otherwise, it's a voting power controlled by shareholders who are Australian residents, right, of Australia, right? So what's the meaning that one? If it is that uh, that's a spelling mistake, Australia, my apology. So that's whenever that's voting power is controlled by shareholders who are Australian residents, in that case that company can be considered as a resident for the tax purpose. So this is when it's come up if you're not incorporated in Australia, right? That's a residency for companies. So tax rate is same for the companies, non-resident or resident companies. However, they are the treatment tax in treatment is different. So if you are a resident company, you must report Australian income and outside an Australian income. If you are a non-resident company, you're going to include only Australian income only, right? Now we will come back to that residency test for individuals, right? Previously we talked about that companies. Now we will say how we going to determine residence for individual. So there are 4 tests. I'm going to talk in a minute. Reside test, domicile test, 183 days rule test, and superannuation test, right? If you meet any one of the tests, you're going to be resident for the tax purpose. Any one of these tests. If you not meet all of this test, you will be non-resident for the tax purpose. If you meet any one of the tests, you will be a resident for the tax purpose. If you not meet any of these, all 4 tests you fail, you will be a resident, non-resident for the tax purpose. So we'll start with the reside test. So I just cut and pasted from that legislation. You can see in the first line, a person reside in Australia according to the ordinary meaning of the word, they will be a resident for the tax purpose. You know that some case laws giving some example how you going to determine somebody living here ordinary meaning of the word, right? So they put it some criteria you want to check together everything. Intention, what is the purpose here? They like to live here. What is the family? Yes, the family, their kids here, spouse here, kids studying, you're doing some work, you have some business here. The behavior in Australia, your behavior is really you want to stay in Australia. You don't want to go back to that country where you come from. Where's your social and living arrangement? You really have here with that other your culture and your other community engagements. Where you are living currently, how long you are here. This type of question will be asked to decide ordinary meaning of the word. Right. So now we're going to um, give some example to understand what the ordinary meaning of the word. For an example, a family moved next door to me. I'm just noticing they move into that one. Just had a quick chat through the in the through the fence, and they said that they moved from a particular country. They got a 12 months lease in my next door. Their kids going to the school, and that's he got a job. He couldn't get the job where he want to because just he moved here. He got a odd job to manage his family, and the kids started to go to the local school. Wife looking for the job. They purchased some little furnitures and etc. to manage, and yeah, they bought a car as well. So they are here. So in my assessment as an ordinary person, they are living here in the ordinary meaning of the word, right? Therefore, from day one, I can consider them as a resident for the tax purpose. Why? All their behavior, all their actions that prove that they're going to be living here. Therefore, they are reside in Australia according to ordinary meaning of the word, right? So they come to the tax return, so we can consider as a resident for the tax purpose, right? Second part, in my other side of that house, there's a ARNB. That's temporary recommendation. Every a family came from other country and staying over there. They hire the budget car, running here and there for looking to different tourist locations. Almost last 1 month, they are running everywhere, all over the Australia, right? But they come back to this house as a one point, right? So how can I say them they are ordinary living in Australia? So they residing in Australia in the ordinary meaning of the word. No. So very clear their intention to not to stay here. So their family and employment and business may be different places. Their behavior is not going to be ordinary meaning of the word. They are living here. Therefore, we cannot use the reside test to them, so they will not satisfy the reside test. Therefore, they are non-resident for the tax purpose. Right. So that's a two example I can give. Other one, domicile test. A person is Australian resident if their domicile. What does the domicile mean? The place that is your permanent home, not the actual building, right? Not the actual house. That your permanent home means you are Australian. You will back all the time here. So your family ties here, your kids here, your wife here, your house is here. So many other factors saying that your place of destiny is permanent home in Australia, right? Unless ATO satisfied their permanent place outside of Australia, right? That's called domicile test. The domicile test a little bit tricky, so I will give you a couple of examples for you to understand what is the domicile test. For example, you assume a backpacker. So he's Australian. He have no house, but this he come out from that his parents, but parents living in Australia, and his brothers and sisters living in Australia, but he went around the world. Last 5 years, he traveled to different countries. He went to all the different Europe countries and earned from Europe and spent that money. He have no any money in the hand. He went to the Asian countries and Japan and China and come back to here, right? So he's come back to home after 6 years. So he started to lodge the tax return. You log into that his tax portal. You can see last 5 years in all in red. Overdue, 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 overdue. So you advised to that client and said that, hey, so you did not lodge that last 5 years tax return. He said, I am not here. I am abroad all the 5 years. I am not willing to uh, 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 pay the tax on whatever I earn outside of Australia. I should be treated as a non-resident for the tax purpose, right? However, when we look into that his action, he's not living anywhere, he's just looking around that other countries and earn. So therefore, and he come back and settle here, right? So and his family, that his family ties and it's other evidence can see his domicile in Australia, even though he's not here last 5 6 years. So therefore, we can consider him as a resident for the tax purpose. Unfortunately, we cannot agree with them. He's a non-resident, so he should pay all the income what he earn other country and lodge the tax return as a resident for the tax purpose. Right? This called domicile test. I will give you one other example for you to understand. Assume that one of your client is family here, 3 children and wife, is working here. However, he got that other job 3 years before in US. Right? Last 3 years he's working in US, and every Christmas he come back to here and stay with the family. He's staying in a temporary accommodation over there. It's not like he not purchased a house or anything. He just rented out a property and living in US. But the family living in his own house, kids studying here, wife working here. Every holiday, Christmas holiday, he come over here and staying to 12 weeks or 10 weeks, and he's going back to US to work. Right? So he did not lodge the tax return because he assumed that his income is foreign. His last 3 years over there, he should be treated as a non-resident. So unfortunately, we cannot consider him as a non-resident. So very clear, he's living in Australia in his old age, and he is a family ties here, his a wife here, and the kids here, and his house here. Therefore, we could consider, and he's coming all the time for holiday. Therefore, I can say he's domicile in Australia. Therefore, he must consider as a resident. He cannot agree with them as a non-resident, so he must include all the income he received from US, and whatever that income that's he received from US should be reported as a Australian resident and pay the tax. Right? There are different. You may ask, what happened that we paid already some tax in US? That can be foreign tax credit. We will talk next week slides. Right? Now I am going a little bit further. The same family, your client, he decide, no, there's more tax here. I will take that my wife and kids and settle in US. He bring that kids and wife, and they bought a property in US. The kids start to study. Last 3 years, they never been back to Australia. That he's changing the job, different jobs in US. Wife started to work also. She also changing the different jobs. They are all happy. Last 3 years over there, kids studying over there. They purchased a property over there. However, they did not sold their Sydney or the Australian property. They rented out this property. Right? Now tax office come back, they send a letter to them, hey, you have income from Australia, you must report to that all of your taxes as a resident. In this time we will be a little bit all right with that your client, because that very rare chance, he come back to Australia because he almost settled over there. Right? Therefore, we may consider him as a non-resident for the tax purpose because he just have a house is as an investment. Rest of the all these family circumstances saying that he is living in US. His domicile really in US, not in Australia. Therefore, we maybe support him to say that you are non-resident for the tax purpose. Only report whatever investment property income you are received from Australia. Right. So this is the way that domicile test work, but a little bit harder. But you may be challenged, but we should be ready with that in our justifications why we decide he's a non-resident for the tax purpose. I will give you one other good example. One of the clients moving from a country as a skilled migrant to this country, he couldn't get the job. Unfortunately, the field where he's coming from, he applied to that different jobs. He got the job from the Commonwealth Bank, but that Commonwealth Bank asked him to go back to his country where he come from. right? Very interesting. The reason Commonwealth Bank recruit him to use that his language ability to manage the clients in their home countries. Mean in his home country there's a branch of Commonwealth Bank branch, right? So they want a person Australian and with that both language English as well as the language. So 1 month time really that he back to home country, but he did not take back to the kids. So wife, they are in a little unit, rented property, little unit. Kids going to the school in Australia. Wife trying to get a job, she couldn't get it. But he back to home country and living in his own home and working over there in the Commonwealth Bank branch. He did not report his income. He said that this is my income from outside of Australia. I should be treated as a non-resident, right? Or he won't lodge the tax return as a non-resident, right? So what do you guys think? Can we accept him as a non-resident? Unfortunately not. Even though he's living in his home country, in his own home, but he migrated here and his wife here and the kids here. So all that other circumstances, even though he's other country citizen, it's very clearly say he's domicile in Australia, right? He just going over there for the work. So therefore, he should be considered as a resident for the tax purpose. He must include all the income he received from Commonwealth Bank in the country we are working should be reported as income for the tax purpose. So I think I gave enough example to domicile test. So you may go to the ATO website and read a little bit more about that domicile test to understand. Thank you. Other 183 days rule. Person actually present in Australia for more than half of the income year. It means 6 months or more, which is 183 days rule. 183 days, we can consider him as a resident for the tax purpose, unless you can see unless their usual place of abode live right outside of Australia, or you have no intention to take up the residence here. So whatever that any of the conditions if you meet, you cannot use that 183 days rule. So very good example for 183 days rule. So one of that prisoner. So he is not Australian resident, he is not Australian citizen, he's other country national. When he traveled through the Sydney airport, he was arrested for the truck trafficking, right? So he's committed to the crime. He got that 5 years jail sentence. He's in the jail, right? He earned some income from the jail. I'm giving an example, right? Example or some scenario, right? So he's in the jail. He earned some income from jail. So $18,000 he earned, for an example, right? So he understands this 183 days rule. He said that I am not going to pay the tax because I should be treated as a resident for the tax purpose because I am living here more than 183 days, 3 days, right? Therefore, if I'm a non-resident, tax-free threshold 18,200, I don't need to pay any single cents of tax. Please give me all the money back, right? So, however, ATO will not accept that arguments. So how is that particular case treated? So the person living here is not ordinary meaning of the word. He's not living here. He forced to living, right? So reside test not work. His domicile test. Where is usual place of his living? Country where he come from. So he's that's also not going to be made. 183 days rule. Where's the usual place? Outside of Australia. Can he get it any residence here? No. If you committed the crime, you will be not allowed to back to Australia. Therefore, he not meet any of these three tests, even including 183 days test. Therefore, he not be resident for the tax purpose. Right? That's the way that rule works. The last one is the superannuation. Australian federal or state government employees who are member of the superannuation scheme established under Superannuation Act, right? In that case, you will be a resident for the tax purpose, right? So whoever that's members of the superannuation scheme under the Australian federal government or state government, they will be straight away resident for the tax purpose. So we have four, that's very straightforward, last one, right? There are four tests. If you meet all four tests or any one of the tests, you will be a resident for tax purpose. If you not meet any one of these tests, right? You not meet any one of these tests, you will going to be a non-resident for the tax purpose. Before moving to that next slides, I just want to start with that one. We cannot use your visa status or your migration status to determine your residency status in tax. For an example, a Australian citizen may be a non-resident for the tax purpose. A student came from other country to here, he may be a resident from next day of arrival, right? So therefore, we cannot use Migration Act 1958 for determine that residency or not. We must use Income Tax Assessment Act 1936, which I saw that the four test here, this is the only you can use. You cannot ask the passport or visa or permanent visa letter or whatever to determine their residency. You're only going to rely on this test. I would like to add one more important point. Sometime in the industry, when the students come over here to tax return, we will ask, you stay 6 months, then you will be a resident for the tax purpose. That's not right. The actual rule for the students, if they paid 6 month tuition fee for a course, and if they arrived in Australia, they can be considered from the day one as a resident for the tax purpose. So what is that rule? You paid a one semester course fee and arrived in Australia with a valid visa, you can be considered as a resident for the tax purpose, right? That's for the students. Rest of the stuff, you have four tests, you can enjoy, right? So now we will move into tax liability. This all you're going to work on that in your Xero Practice Manager. So you remember we created number of tax returns. You put it that to every different tax return and see how is that work. So I'm going to share with you quickly to see that how that this residency impact on in our tax return, right? I'm going back to that in our original client. That's Steve Smith. I'll put that 100,000 back again because that's the way it's worked. Yeah, no, we can work with the 20,000 as well, right? How much the tax he should pay? 25,717. So that's I'm sure that you can see that power in our practice manager. So 25,717. You go to the cover page, change his as a non-resident. How much he want to pay? 32,000. So to determining that resident or non-resident is very important. You can see almost around $5,000 different, right? 32,950, otherwise 25,577,717. So the big difference. So in your one click going to make big difference to the client, right? Therefore, you should be very clearly understand how to determine resident or non-resident. Right now, I go back to that. So this is the one. Now I go back to the company. I said that there are two tax rate under the cover. If you go to the bottom of that one, there will be a base entity. What is the base entity? Less than 50 million turnover in 1920, we can consider as a base entity, right? And that passive income, I said that only that few businesses will be exempted from that. You must check with that one as well. So if you click no, 2,673, what happened? Yes, you see it's going to come down your um, tax payable. So therefore, you must very careful with the Australian residency status as well as tax rate applicable for base companies, base entity as well. You should not click just yes if someone over 50 million turnover. You must check their financial report. If their turnover over less than 50 million, check there what the income coming from normal sales. You can click on sales, right? In that case, you will be pay. You will support your client, right, to paying the less tax legally. Excellent. I will back to that in our original screen immediately for that here. I'm sure you can see that now in our income tax liability. So work with that all different income and check that how much the income we want, how much the tax we want to pay. Right. So that's the one in your work next. Now we will move into that in our PowerPoint session. Medicare levy. The Medicare levy have two part, Medicare M1 and M2. Medicare levy M1 is a normal Medicare levy, 2% of taxable income. Medicare levy surcharge M2, which is calculated differently. I will explain in a couple of slides later. Start with the normal Medicare levy. So the normal Medicare levy 2%. That's fine. Everyone, when it is will be calculated. However, very important, we must understand there will be exemption for the Medicare levy. What's the meaning? Someone no need to pay that Medicare levy. So we will see who no need to pay the Medicare levy. You can really support your client couple of $1,000 reduction in refund for them, right? So it means you must very clearly understand what is the Medicare levy, how I am going to that reduce the Medicare levy for my client if they're eligible, right? So we will see how we can reduce or how we can reduction or exemption. One, foreign resident exemption Medicare levy. If you are a foreign resident, you no need to pay the Medicare levy. If you are a non-resident, you no need to pay the Medicare levy because most of the time you are not eligible to Medicare levy, Medicare card, right? So the Medicare benefits, therefore that will be exempted. Second one, if you are not entitled to Medicare benefits, you are here, you are an Australian resident for the tax purpose, you may be a skilled migrant, you may be a student, you may be a different category of visa holder, but or that's a resident here, but you are Australian resident for the tax purpose. However, you may be not entitled to your little Medicare card. We all know that Medicare card, right? So if you are not entitled to the Medicare card, you can exempt it from that your Medicare levy M1 and M2. You no need to pay any of them, right? So that's called second exemption. Third one, medical exemption Medicare levy. If you are a blind, if your client is a blind pensioner, or your client receives sickness allowance from Centrelink, or entitled to the full medical treatment for all condition under defense force arrangement, this type of circumstances, then they will be exempted from the Medicare levy. So you can click this particular link and read a little bit more about that one, right? And dependents Medicare levy exemption. Your wife not working, she's depend on you. You are looking after her accommodation and medical and food and clothing. You can consider her as a dependent. So a children's under 21 normally considered as a dependent. Children's between 21 and 24 old studying full time in education at school or college or university, right? But their adjustable income is less than 1,786. In that case, they also can be considered as a dependent for the Medicare levy exemptions, mean reduce the tax. Now I am going to our Steve Smith example and see how you going to actually work in the practice manager to do these exemptions, right? So what the four category of exemption we learned: foreign resident, not entitled to Medicare benefits, Medicare exemption from Medicare levy, and dependent Medicare levy exemption, right? Now we will click on the Medicare. We'll see how much the tax now Steve Smith should pay. 32,550. I want to change something here. He should be a resident first, right? Okay, good. So how much resident? No. Okay, good. Australian resident. Right. So he's going to pay. Well, good. That's enough. All good. So we will move into the Medicare section and say here, assume that he have that um, he have the two children dependents. Right. Click this one and see what's happened. I think we have somewhere. Steve Smith should be checked. Australian resident. This one. Give me a 2 second, guys. I want to reload this page and get it the right calculation. Okay, that's why I'm confusing. There should be a 25,000 because previously I did some test. Right. So how much that 400,000? How much the tax for him? 25,717. So I will click on that Medicare and take it out this two and see how much the tax. Right. Right. So let's see here. Okay, that's coming from the business income. Give me a 2 second. I will do some changes here. We will delete this 100,000 as a business income out. Right. Validate and we'll go to here. Income. Let's take some couple of seconds, guys. I will work on that. So I couldn't work it out where it is. Why it's not coming out? Okay, 65,000, 60,000. I'll put it here. Now we put 110,000. How much the tax? 29,000. All good. So go to that cover page. Is Australian resident. So become no, that's right. All good. So his will be resident. That's right. So now we will come back to the Medicare. Assume that he's a student, right? So he don't have Medicare benefits. So what's going to do? We're going to exempt his one. You can see $2,000 different immediately, right? Assume that he have two kids, right? We'll take it out this one. How much? 29,997. So some reason it's not working. I'm sure that because of the spouse, right? So we will check that later. When you put it this one, it will should be changed, right? Put it numbers a little bit more and see what's happened, right? So that function is not working, but when you put it that this one, it should be changed. So assume that he's not eligible for Medicare benefits. So you'll put that 366 or whatever number. You can see it's coming down. That is a particular tax amount, right? Also, that other one is the Medicare levy surcharge, right? So we will see the Medicare levy surcharge. How does that work, right? So I'm really want to try and get it this dependent children's change it that income and see how does that work, right? Right. I just want to see that when we put it that so he's all right. Medicare, two children's. No, that's not working. But I will work it out and let you know that next week. But it's surely that's there will be a formula connected with that number. Ah, yeah, I know that why it is because we entered that wife. So I will take it out Smith's wife some reason because we did not do the Smith's wife tax returns, right? So we will delete her. Then we will work it out. Right, so how are we going to delete edit and delete her from here? Right, because we did not do the tax return other side. Go here. So now we will go and see. Right, so honestly, I couldn't work it out, but the reason is not coming up. Normally, when you put your dependent children here, it should change this number. It seems to be changing. I will work it out and let you know. There are some data entry issues in the down. So you can see here that if you exempted, very clear, it's coming down, and that's in that particular Medicare setup for them, right? So that's a Medicare levy. When we come back to the Medicare levy surcharge, so how does that work? Medicare levy surcharge. When if you have a hospital cover, private hospital cover, if you click here, you can see. So I'm going to increase the income some reason, otherwise you will be not get it Medicare levy surcharge. Right, so we'll go to here again. We'll back to 110,000, right, as a single. I know is that it's Medicare. So now you can see. So if you take it out, right, so take it out here, how much the tax you want to pay? 29,000. Something wrong here. I'm sure that's a resident. Yep, 29,000. So we will go back to that in our Medicare, right, and say he have the insurance. Click here. I'm not sure why that should be work, right? So give me a 2 second, guys, then I will work it out, and we will work. Thank you, guys. I found that, but it's an issue, right? Um, that's give me a 2 second. I will just sharing that Power Practice Manager now. All good. There are some data and inside. When I entered, I treat Simit as a non-resident. That's why it's not reflecting when I enter that information in the Medicare. Here it is. So now click the Medicare. Can you see 110,000? How much the tax is going to pay? 31,292. So what we're going to do, we will say that Steve have 2 kids, dependent children, right? So click here and see what's that going to happen, right? 29,000. So everybody happy with that? So when we increase the 2, it's going to be, sorry, it's going to be changed is tax amount, right? So dependent children are very, very important to minimize. So you are helping him almost $2,000 refund, right? If he's a student or if he's not eligible to Medicare card, you can exempt. For an example, he's a student or skilled migrant who is not having that Medicare benefits. So in that case, you can go in a whole day. This year, 366 days, 2020. That's why I put it 366, otherwise 365. So when I put it, you can see this coming down, right? So if you put it anything here, you want to get that exemption certificate, levy exemption certificate from Human Services Australia, or now we call Services Australia, right? The client should directly apply to them through that email address. It will be provided, in your work. In when you started to work, we will give you the details. So they should directly apply through the email that they will email back to the client exemption certificate for students or the migrants who are not eligible for Medicare levy, Medicare benefits, right? So some of them maybe get that Medicare card during the year. For example, your client get it 1st of January 2020. In that case, how many days really he is exempted from the Medicare levy? Half of the year. So how many days? 183 days, right? So you want to put it. So it's a little different here. So this one's very important to report to it. You accurate your Medicare levy exemptions, right? Now then we move into that Medicare levy surcharge. As I said, Medicare levy surcharge, I will take it out this one at this point. You may be Australian resident, no matter that whatever that's you have Medicare benefits and etc. But if your income goes above a certain level, you are required to pay Medicare levy surcharge. How much the income for an individual? 90,000 per year. If you are a family, that's going to be $180,000 per year. If you go above that level, you're required to pay the Medicare levy surcharge. However, if you have private health insurance, you no need to pay. For example, if we click here, just you have that health insurance, you can see it's coming down, that number. So whoever have private hospital cover, not the general cover. If you have a private hospital cover, what's going to happen? You click the yes button, then your Medicare levy will be exempted. Right, Medicare levy will be exempted. One reason. Second reason, so if you are single, less than $90,000, your Medicare levy purpose income, you can exempt it. Or if you are a family, your family income less than $180,000, you can exempt that both partners from the Medicare levy surcharge. Now, I will show you one example quickly. I'm going to reduce this one to 90,000, right? 85,000 to show that how we go into that exempt, right? So we'll put the here 85,000. So now how much that my client is a individual single, he not married, his income is 85,000, but should not be taxable income. That's a different way it's calculated. You don't worry about that. What is the component? There are 5 component include in that one, which is include that your taxable income, reportable Frenchy benefit, no investment loss and financial investment loss and rental property loss, and reportable super contribution and any amount from your family trust distribution, right? That's the MLS purpose income. It's a little bit complicated for you at this stage, but don't worry, you don't need to remember that one. What you want to do, go to the income test and down to that little bit down, you can see how much that Medicare levy purpose income for this client, right? So you can see income for the Medicare surcharge purpose. How much here? 85,000. He's single. He's not married. So what are you going to do? So this is the one, right? Income test IT8, right? Go to the IT8 and see how much the system say your income for the surcharge purpose. How much it is? 85, right? For an example, I will going to show you a little trick now, right? So 85,000. So I'm going to click here. He got some Frenchy benefit for an example, right? He got the Frenchy benefit, $4,000, right? Here is any change? No, taxable income is still 85, right? Not change anything. But if you go to income test and see ITR 8, now this is 89,000. Got it, that idea? So income tax for surcharge purpose include 6 other items, right? Not only just taxable income. So every time when you exempt, you should click that income test and go to ITR 8 and see that what is the tax purpose surcharge income. Yep, 89, less than $90,000. Now we will go to Medicare and say he have no hospital cover, but I am going to exempt him because his income is less than. Everybody happy with that? What I'm trying to do? So what I'm saying, even though they have no Medicare hospital cover, right? Private hospital cover. Yes, I know we don't have, but you no need to pay that Medicare charge because your income test so ITR rate, so income test, so you are only 89,000. If it's a family, this number should be 180,000. When you do the tax return for his wife, and it will come back here as a total income for surcharge purpose. You check that less than 180. Every children's will be added 1,500 more. So you can go and exempted from your Medicare surcharge, right? So everybody understand what we talk. First, Medicare levy, who is going to be exempted? Students going to be exempted, right? Or that people who is not eligible to Medicare levy, normally exempted. Students mean international student I am talking about, right? So whoever not eligible to Medicare benefits, they can be exempted here. So children and the dependent children's you can include here. So automatically will calculate that one, right? So now I will take it out everything so you understand how is that work. All right, so we will go back. Go back to that in our original slide, which is, give me a 2 second, guys. All right, we are here. Medicare levy, this is the one we talk about. There are a couple of examples for you to do. You enter the 42,000 and see $840. You can see the taxpayer, if they cease to be a resident or become a resident in the middle of the year, you want to calculate the Medicare. You can exempt the Medicare levy based on that number of days they are eligible to Medicare, right? So very important. That's the number of days exemptions. There's one example here. You try that same example in your XPM, you will get that same answer, right? Then we come back to the Medicare levy. So I just updated. I don't know in your homework it's updated or not. This is the 1920 rate. So if you are a pensioner, if you get it at your income less than 36,056, you no need to pay Medicare levy. If you are all other taxpayers like you and me, less than 22,801, you no need to pay that any Medicare levy, fully exempted, right? The system will automatically calculate. For example, if you go back and type that $11,000 in your XPM, you can go to estimate section and see Medicare levy is zero. Why? It is take it out from that, right? If your income goes above 45,000 as a pensioner, 45,069, you will be taxed 2% of taxable income, right? But if you are going as other taxpayers like all of us, 28,501, if it go to that above that day limit, you will be taxed 2%. If your income between this threshold, so for an example, somebody got the 25,000, he's not pensioner. He is between these two bracket, 22 and 28,501. So how is that going to work? So your taxable income, which is in our example 25,000 minus the lower threshold 22,081 times 10%, right? I think I did an example here. Janice is a single taxpayer, 52,000. How much is taxable? Yeah, 52,000 is about 28,501. So 2%, which is $1,040. Harold is a single taxpayer. His income 23,000. He's a normal taxpayer, not pensioner. So all taxpayer limit is he's middle of that one, the shading area. So how we going to calculate 23,000 minus 22801? I think in your homework a little bit different this number, but the actual number, the right number is 22,801 1920 single rate. I think in the homework 18-19 exercise we did that. The previous year threshold will be different, right? So 23,000 minus 22,801, 10%, $19.20. If you go and enter in your Xero Practice Manager, Harold's income as a 23,000, you will get it if you go to that your estimate section. You can see $19.20. So we will see this one is work or not. Give me a 2 second. We'll go back here and I'll go to the income and change that this income to how much we are going to change. 23,000, right? 23,000. I will take out that friendship benefit stuff and go to the Medicare, and I did not put anything. Take it out. Right, so all good. So that's right. So we will come back to estimate section and go down a little bit. You can see here Medicare levy $19.90, right? It's calculated based on that. That's 22,801, my 22,801, right? So what's that threshold minus that amount? So you want to work it out this the way. How we going to reach that points? So now I will come back, share, go back to that in our original screen. And give me a 2 second. All right, we are back. So I think that's there's a typo, that 23,000 minus 22,801 times 10%. It should be $19.90, right? So that's the one that exactly in the XPM. I saw that the typo, I corrected here. I will upload this here PowerPoint most probably today itself, the right version. Then we will move into that what's the next topic? So that the family will be different, right? So that's you can see family tax rate will be different from individual one. So I cannot see that one. So here it is, right? So the Medicare levy reduced to the family taxable income is equal to less than 62,738 for the pensioners. For the other taxpayers, 48,092. What is the meaning? And plus 4416 every dependent children you have, right? So 4416. So how is that work? For an example, if you are a husband and wife, your total family income less than $48,092. So you no need to pay, both of them no need to pay that Medicare levy because they are under the threshold, right? Every children will be increased 4416. However, you when you test this one, you must do that the wife tax return as well, and you must enter all of your dependent children's and etc. So at this point, what you want to think, if some family income less than 48,992, you are not required to pay that, or you will be reduced rate, you will be paid. So you want to see that calculations. When we do some homework questions, you can understand, right? Just apply that through the Xero Practice Manager. Prepare the two tax returns, one for the wife, one for the husband, and link both of them and enter the information. Automatically will calculate this area, right? 62,738 for the pensioners and 48,092 for the other taxpayers. For an example, husband income 48,000, wife income zero, it will be a different treatment. So for an example, wife income $30,000, husband income 10,000, it will be a different treatment. So to do this one, what you want to do, you want to create husband's tax return, you want to create wife tax returns, then you link both of them, right? Then go to see each of their Medicare levy, how is calculated. If you put that your dependent children, it will be also changed that your Medicare levy amount, right? So this is the threshold amount. You cannot say 100%. For an example, in our family income 45, $47,000, we no need to pay the Medicare levy. You cannot say like that. It's depend on that combination of that both of your tax return or both of your taxable income. So therefore, please create the two tax returns, one for husband, one for wife, and link both of them as a spouse. Then prepare the tax return and go back to the Medicare levy and see how is that Medicare levy impact on combination of income, right? So then we will go into the Medicare levy surcharge. What is the Medicare levy surcharge? I already talked about that. Then second component of the Medicare levy, MEM1, normal Medicare levy, we talk about up to now. Medicare levy surcharge, I talk about clearly. If you have a private hospital cover, not the extras or general cover, right? You no need to pay that Medicare levy surcharge. Individual and families, if they hold that income less than Medicare levy surcharge threshold, you no need to pay the Medicare levy surcharge. You remember I said to that in your XPM, you go to that in your income test, ITR 8, right? Check that what is that Medicare levy purpose income. If it is the income less than $90,000 for a single, the MLS purpose is zero. If it's the family, $180,000. If you have two or more dependent children, every additional children is going to be calculated 1,500 more on your threshold amount. For an example, you have two children's, your family threshold will be 181,500. Family mean husband and wife and one children, right? Single with that one children, can be increased at 90 plus 1 500, right? That's the way it's worked. Now we will move into that. So I think I explained this one very clearly. Different percentage, you can see if you are stay in that other bracket, 1%, 1.25, 1.5 percentage, this all will be looked after by that in our Xero Practice Manager. You no need to understand how is that work, but you should know this is a different percentage for each income group, right? So it will calculate it differently. For example, your family income 300,000, your Medicare levy surcharge will be 1.5 percentage. If you are a single, your income 100,000, you only can pay 1% of Medicare surcharge, right? Medicare levy different from Medicare surcharge. So for your own information, how this in our income test ITR rate medical levy surcharge purpose income calculated based on the taxable income, reportable fringe benefit, no total net investment loss, total net financial investment loss, your rental property negative gearing or property loss, reportable super contributions, and any amount which family trust distribution as tax has been paid. So these all items include in our Medicare levy surcharge threshold, but you no need to manually calculate anything. If you provide key in all the information when you prepare your tax return, it's automatically come under the ITR 8, right, as a Medicare levy surcharge threshold. That's why, and how actually this 1% calculated is calculated based on that your taxable income and reportable fringe benefit and any amount which your family distribution tax has been paid. And 1% or 1.25 or 1.5 is based on that your income bracket for Medicare levy purpose income. How actually you calculating that Medicare levy surcharge, that system will do. But if you want to know how, what is the amounts included for that percentage, taxable income, total reportable fringe benefits, and amount family trust distribution. You can ask me, Shan, couple of seconds before you said that 5 of that one, that's for to determine you want to pay Medicare levy surcharge or not to calculate the Medicare levy purpose, right? So this all the items what you can see under the Medicare levy surcharge MLS threshold to determine we want to pay the Medicare levy surcharge or not. If we decide yes, you required to pay, then we go to the second slide. These are the 3 items we should include times 1% or 1.25 or 1.5, depend on the um, 1 second, guys, depend on that how much income for Medicare levy calculations, right? Good. So I know that a little bit confused why this here 3, there's a 6 or 7. The reason is the first part to determine that taxpayer is liable to pay Medicare levy surcharge or not. That's called Medicare levy purpose income, right? So calculation of Medicare levy, only taxable income, reportable branch benefits, any family trust distribution has been paid, tax has been paid, the total amount times 1% or 1.25. But you no need to you are not going to calculate in the when you are working. What you are doing, you are clicking that when you put that all the information, that system will calculate your Medicare levy surcharge accurately, right? So here's one example. You can see, yes, Medicare levy purpose income is 105. He's a single individual, so he required to pay 1%. So 1%, 105 times 1%, 1050. Right. So that's the way it's work. Right. So I will see other one example. What is this? Taxpayer MLS part of the yeah, it's good. So MLS will be a portion based on the number of days taxpayer does not private health insurance. I talk about very clearly. So if someone get the private health insurance during the financial year, so you want to put the JS, they have the health insurance, right? But you want to put that how many days they are exempted, right? Where a single, no dependent is taxable income this much. On 15 September 2019, he took that private health insurance. So how much you going to do? We will going to take it out. You can see he's 1.25 percentage, but he is exempted only 1st of July 2019 to 14th of September 2019, which is 76 days. So you're going to exempt only he that particular days, right? So the rest of the day he required to pay that he only going to pay that Medicare levy surcharge. How many days he's really that have no private health insurance. Rest of the days we can exempt it, right? So his liability only for 76 days. So 365 minus 76, that's a number you're going to enter in your exemption date. How many days exempted? You're going to put 365 minus 76 in that in your XPM, right? So that's a Medicare levy surcharge. Lower income tax offset, that's called LITO. 1920, the people who get the lower income, so whoever get less than $37,000, tax office is going to reduce their tax liability by $445. That's called tax offset. So what's the meaning? So lower income earners, they will get some tax concession from ATO. So how much that? There's a table you can see. 37,000, if you are lower than $30,000, you will get $445. If your income between 37 to 66,666, it will be a different. You can see 45 cents reduced by every 1 point cent, every dollar for 1.5 cents, right? It's mean, so if you are between 37 to 66, you will be get less than $445, because every single dollar you are losing 1.5 cents. If your income goes above 66,667 or 666, so you're going to be not get it any LITO, right? So that's the one, LITO. LITO is a non-refundable offset. What's the meaning non-refundable offset mean? Only you can offset your prime tax, right? You cannot offset your Medicare levy. Only you can offset your prime tax. So whatever taxable income, based on you calculate the tax, that tax only you are reduced. For example, you calculate your prime tax $300, right? But your taxable income 35,000 for an example, right? So how much you have actual that offset 445. So you can only offset $300 because you cannot offset more than 445, right? And you cannot get, so you cannot get the refund of $145. That's called non-refundable tax offsets. What's the meaning? You can maximum offset up to 445, right? So that's if you are if your tax amount less, that you can only offset up to that what is your prime tax amount. Rest of that amount is foregone, right? I will show you one example to understand. LITO not reduce the taxpayers liability for Medicare levy, right? So Medicare levy, it is after offset only calculated Medicare levy. LITO is not a portion part of the year residency. What happen if you are at least a day Australian resident, you will get full amount of offset. It's not going to be a portion how many days you are in Australia or not. It's not the question, right? So if you are an Australian resident, at least a day, if you have an income, you are eligible to get it at lower LITO, right? Taxpayer can earn, for an example, the example here you can see $445, you will be offset all the amount taxable zero. Then if there's a Medicare levy, you must pay that, right? So we will go back to that LITO other example, 50,000, when you put it LITO, how much? $250. So what we will do, we will show that two examples here and we will check that too, right? The first one, $445 offset, right? So it's saying that 250 that in our LITO offset. Second one, 18,900 is offset only $133. So I will go back to that in our Xero Practice Manager to explain this one. How is that work, right? So I'm sure you can see now this one. So how much the first example? 50,000. So I'm going to change that income as a 50,000 for this client. You must do all the stuff in your home to practice this, right? 50,000. So how much that will go to the estimate section, right? See that how much that in our $250 lower income offsets, right? Life to $250. So I'm going to change that income to that second example, $18,900. Right. So we'll go to that number one and click here, 18,900. Right. So now we'll go back to that estimate section. You can see you have available $445, but actually reduce only 133. What's the meaning? The LITO, you cannot get the refund. Only you can offset maximum tax amount. Right? You cannot offset, you cannot ask, I have $445, only you are reducing 133. Can you give me balance as a refund? You cannot. That's called non-refundable tax offset. Right? So you, even though you have less than $37,000 income, you are eligible to $445, but you can only reduce 133. Right? So now we will move into that LITO, and I will move back to that in our original screen, new share, and move into that our screen. So this is the one we see that. Now we will move to LAMITO. This is different from LITO. LITO, lower income offset. This is low and middle income offset. So you can see there's a table up to 37,000, you will get $255. 37 to 48,000, 255 plus 7.5 cents each dollar over 37. Then 48 to 90,000, 80, 90 to 126,080 minus 3 cents each dollar over 90,000. All right. So this is the table based on your um, client's taxable income. They will get this refund. All right. So based on that taxable income, they will get this refund. So we will work it out based on the based on that bracket. So some clients may be getting both LITO and LAMITO. For example, your client is $25,000. So in that case, they will get it both LAMITO and LITO. So anything over 66,666, they will not going to get LITO, only they will get LAMITO. Right? So same rule. So non-refundable tax offset, I explained. LAMITO is non-refundable offset, meaning can only reduce the taxpayer's tax liability to zero. That's mean you cannot get the refund if you have more offset. LAMITO does not reduce the taxpayer's liability for Medicare levy. That's one I explained. So this is going to be operation up to next year. Right? Now what I am going to do, I'm going to back to that in our, there are a couple of examples here to use to see. You can see 42,000. They said that two different offset, LAMITO and LITO. Another one 98,000, only LAMITO, not LITO, right? So 42,000 and 98,000. We will go back to our practice manager and we will see how that it's going to be. We're going to work with that one. So I will go to the income and go to income and change this one to the first exercise, which is first example, which is 42,000. I will change it to 42,000 here, and then we will come back and go to the estimate section and see what we did right. Yep, you can see lower income offset. You are going to get $370 because 42,000 within the bracket of 37 to 66,666. That's why it's differently calculated. 37 lower middle income offset. So what is that? 42,000. So he will be in that between 37 to that 48,000 bracket, which is differently calculated. 2.255 plus that 7.5 percentage. This 630. He will get both offsets. So now I go back to that second example, 98,000. So I will go to the here and click on edit and 98,000 and see what's it happen. We'll go to the estimate section. You can see there's no lower income because over 667. Therefore, he's only going to get 840, which is the lower middle income offset. Right? So between 98. So I want to see that something put it at 60,000. How much the lower middle income going to be? Right? So click here. Or that I will put only 75,000 to see only you want to practice like this, right? That's the one important. Click the estimate. You can see the full amount 1080 they will get it because that's come up between 48 to 98,000 they get the full amount. So this is the way we work on that practice manager you to practice well. Now we will move into lower middle income tax-free threshold. You all knows that tax-free threshold is 18,200, right? However, but if you full year only 18,200. What happen if somebody come middle of the year as a Australian resident? How much we are going to give them threshold? It will be a different. Right, there are a two component inside this 18,200. One called 13,464. That's a flat amount. Other one 4,736 is a additional component or a flexi component. So whoever at least a day Australian resident, they will get the flat amount of 13,464. But the additional component will be a portion based on number of months they reside in Australia. So how is that we are going to determine? For example, a person come to that last month, only 1 month, or that normally considered if you come in a month, that month will be covered as a 1 month, right? So you see here 13,000 plus 4,736 number of month resident of Australia divide by 32. So I'm giving some example here. You can see Louis 25th December 2018 he came. So he's 25 December 2006 drive 30,000. So how much is threshold? So 13,464. He came here December. So therefore that we're going to consider him as a 6 month. So if you 476 divide by 12 and 6, so you're going to get that uh, December 2019. So it's a July 2019 to until December 2019, which is 6 month. So he will be get it. He ceased that residency, right? It's mean he went out from Australia 25th of December. So even though 5 days before the 6 month, you see we are considering 6 month. The same case if they come here as an Australian resident, also that's the way you're going to use. So 5582, they are threshold tax income and you taxable income when you calculate, you can see we are not using 18,200. Now we're using 15,832. So this automatically this calculation will be happen inside in our tax software, right? So I'm going to that cover everything what we talked today is a full cover. So there's a comprehensive example here. 110,000 reportable benefit, French benefit 2,000 and 36,000. If you do it through our Xero Practice Manager, you will get the right answer. So I'm going to share with you guys quickly that the Xero Practice Manager. Uh, couldn't find it out. Yep, here it is. So what is the information? $110,000 income. So I'll go back to that in our edit. So $110,000 taxable income. So I'm just putting because we did not have any deductions at this point. And we have 20,000 Frenchy benefit. There's the Frenchy benefit sections here. And so we have paid $36,000 tax. That's good. That's only the information. And it does not have a private health insurance. All right. So we will see how is that work. Go to the estimate section. You can see 28,197. That's a tax. And we will see Lamito. Lito is not there because he's over 66,666, that number. Therefore, only that $480, which is come from lower middle income offsets. When you go back and we will see how much that is Medicare levy. You can see Medicare levy, Medicare levy 2,200 for Medicare levy and Medicare levy surcharge 1,625. So the total 4,458 raw. So what you are going to do, so now I come back to that our original screen, which is going to be in our PowerPoint slides. So you are here. So what you're going to work, so this is the exercise work. I will upload this PowerPoint today. So you're going to practice all the PowerPoint examples and your homework using the Zero Practice Manager. Check that answers. If you're not happy with that, send an email to that tutors. They will explain to you clearly, right, by email or through the Zoom. So how you success in the course is depend on how much practice you are doing. So we encourage you all to that involved with the Zero Practice Manager, and get that skills and knowledge for to work as a competent tax consultant. Thank you, everyone. Good luck with your workshop and your homework one, and looking forward to see you next week. Thank you, everyone. Bye.